Hello everyone and welcome back. And if you're new here, this channel turns accounting into plain English. Today we'll get a bit more technical and learn how to build an indirect cash flow statement from scratch, using our trusty Apple business example. So, as you know, there are two options to present operating cash flow: direct and indirect. Direct cash flow means exactly what it says, directly recording cash receipts from the customers and payments to suppliers, employees, rent, etc. It looks like this and lists every cash in and cash out. Most companies, however, choose the indirect route because it explains why profit and cash differ. Let's have a detailed look on how the indirect cash flow is constructed from the financial statements of our Apple business. Let's start with the balance sheet of our business in year 1. We have a truck with a value of $150. That would mean non-current assets of $150. Then we have inventory of apples of $30, 3 apples $10 each. Receivables from our customers are $50. Also, we have cash of $60. Total current assets are $140, and total assets are $290. On the liability side, we have equity of $130. And by the way, let's record our equity and liabilities with negative signs, so that we can easier distinguish them from our assets. Equity would be our profits from previous sales. Also, we used a loan from the bank to buy a truck and have $100 remaining to pay back. Liabilities to our supply of apples, our farmer, are $60. Total liabilities are $160 and total equity and liabilities are $290. And balance sheet balances. A new year, year 2, arrives. During this year we sell 5 apples for $100. The cost of these apples is $50. But we had only 3 apples in stock. To sell 5 apples we need to buy more from our farmer. Let's assume we buy 7 apples, to have something left in stock after the sale, just in case. Then we paid ourselves a salary of $10 and a rent of $5. And as our truck will last us for 10 years, we deduct 1/10 of its cost as depreciation. So we depreciate our truck by $15. Our operating profit is then $20. On that we pay a tax of 25% of $5. Our net profit is $15. Now, because we've had quite a few transactions, our balance sheet will also change. Let's analyze it and expand our balance sheet to include a new column to the right. This column will reflect new balances for a new year. What happened to our truck? We depreciated it by $15, so now we have $135 left. Let's look at our inventory. We had 3 apples, bought 7 and sold 5. What do we have left? 3 plus 7 minus 5 equals 5. At a cost of $10 per apple, we now have $50 in inventory. Let's move to receivables and assume we collected all receivables we had from year 1, but in year 2, from $100 of our sales, we still have $30 uncollected. In the bank, we have $45. Total assets are now $260. Now we move down to equity. We had $130 last year. In year 2, we generated a profit of $15. Profits go to equity, so we will have $145 in equity. In the meantime, we have repaid $20 of the bank loan and have $80 remaining. And we have settled all our old trade payables and paid for half of the new purchases from our farmer. We bought 7 apples for $10 each, so 50% of those results in a $35 liability. So we have total liabilities of $115 and total equity and liabilities of $260. Let's move to construction of an indirect cash flow. We start with a net profit of $15. We add back non-cash items. In our case, it is depreciation of $15, so plus $15. Now we are moving to changes in net working capital. Our net working capital is inventory, receivables and payables. Let's have a quick recap. Remember, when we have an increase in inventory, receivables or other assets, it is a deduction to cash flow. We have spent money on it or someone owes us money. When liabilities increase, it's a positive impact on cash flow, as we didn't pay someone. What do we have? Inventory increased by 2 apples, from $30 to $50, so it's a minus $20 cash flow. Our receivables decreased from $50 to $30. That means we have collected more money from our customers. This results in a positive $20 impact on cash flow. Payables decreased from $60 to $35. That means we paid more money to our farmer. That is minus $25 to our cash flow. As a result, the net change in working capital is minus 20 from inventory, plus 20 from receivables, and minus 25 from payables. In total, minus $25. What is our operating cash flow? Plus 15, plus 15, minus 25 equals 5. So we have got only $5 in cash from our operations, though we have received profits of $15. Let's move to investing cash flow. We have not bought any new trucks. That means zero investing cash flow. Free cash flow stays at $5. Now we are moving to financing cash flow. We paid back $20 of the loan. You see, on the balance sheet it decreased. Minus 100 liability less 80 liability equals minus 20. Net payment, which you can directly see from the balance sheet. Net financing cash flow is minus $20. Total cash flow will be operating cash flow of 5 plus 0 investing cash flow minus 20 from financing cash flow equals minus 15 total net change in cash. Let's plug it into our last year's bank. $60 minus $15 equals $45. What do we have in bank on the balance sheet? 45. It matches. And see, cash went down, yet the business is still profitable. Normally, when you have to calculate the cash flow, the quickest way to do that is based on a P&L and two balance sheets. You start with net profit. Then you deduct the current year's balance sheet from the last year's balance sheet as the change in it to get to the cash flow items. In simple cases, you just skip equity, as it is already in the profits we start with, and cash, as change in cash is the result of the cash flow. Here you need to be careful with one point. If the liabilities are recorded as negative numbers, you deduct current year from the last year. For example, with payables of 40 in the last year and 50 in the current year, you deduct minus 50 from minus 40. Then you will get to the plus $10, as a minus on minus results in a plus. If the liabilities are recorded as positive amounts, you need to change the direction of the deduction and deduct last year balances from current year balances. You will deduct 40 from 50 to get to $10 positive. Remember, an increase in liabilities has a positive impact on cash flow. That should always be a sense check. What could we have done to improve our operating cash flow? For example, could we have delayed payments to our supplier? Yes, that would have resulted in higher payables and saved cash. We could have also pushed our customers to pay faster, or buy less inventory, or sell our receivable to a factoring company. But this is a topic for a separate lesson. Managing net working capital is extremely important to secure consistent and stable cash flows for the business. And remember, always reconcile to the bank balance. Numbers must add up. So let's summarize it. Indirect cash flow equals net profit plus non-cash items plus minus working capital changes. Increases in assets absorb cash. Increases in liabilities release cash. Always tie the sum of operating, investing and financing cash flow back to the bank balance. If it doesn't match, keep digging. Watch profit and working capital movements very closely every period to become a good cash manager. And that's exactly how the indirect cash flow statement is built. One profit number, two balance sheets and a bit of detective work. If it was helpful, hit like, subscribe and that bell so you don't miss the next episode. See you soon!